So yesterday we took it slow. We were trying to get into definitions and trying to explain what does group entail? Why do we have to consolidate? So we did the introduction and all that. So today we're going to continue to apply what we have learned yesterday, looking at applications. Now, of all the things that we learned yesterday, how then do we apply it? Right. So that is what we are going to be doing today. All right. So I will share my screen at once. When it's going to be a question and answer session. Stop me at any point in time. Stop me if you're not understanding anything. Let me know about it. I'll stop. I'll explain. Ask me questions, as many questions as you want. There's nothing like a stupid question. There is nothing like that, guys. So ask me as many questions as you want. What you need to understand. I don't care to repeat myself 5-10 times just for you to make sure you understand. The principles are very, very important. So stop me at any time. It's going to be a question and answer session. I'm going to ask you questions. You're going to ask me, and I also expect you people to ask me questions. And we're going to learn together. And I think that is the best way for us to be able to interact and get things done. So I'll start with a bit of an overview. Just to recap for about 2 minutes what we did yesterday. Then we'll flow slowly through what we'll be doing today as well. And then I will start off by giving a bit of an exercise, just a very easy general entries for us to joggle our memory about accounting and about what are general entries and all these general entries that I'm going to give you to do are very important general entry that actually will affect consolidated financial statement. If you understand, we're going to go through it. And then once the exercise is done, then we will go through the application. It's going to be very interesting and very interactive. We're going to apply it to real lives. We're going to apply it to real life situations as well. Good. So let us start. I'll share my screen. Good. So consolidation of a wholly owned subsidiary at acquisition. So before we begin, why do we consolidate? So yesterday I said that the reason why we consolidate is that companies will start off to, maybe a company will start off to be a sole proprietorship. After some time, the company will grow and they decide to form a partnership. Then the company will grow to a extent that they want to be a company. Then the company they'll register as a company. The company will grow and it wants to acquire other companies as well. And once it starts acquiring companies, then the company is getting bigger. It's got a parent company and subsidiaries, right? The International Financial Reporting Standards requires us that when we have a group of companies where a company has acquired other companies, we have to prepare a consolidated financial statement. What that means is that we need to bring in the financial statement of all the subsidiaries or the companies it controls together to form what is called a group statement or an annual financial statement. It is by law, if you are a parent or a holding a company and you own or you control certain companies, you are supposed to prepare. It is a must that you have to prepare consolidated financial statement. So this model helps us to be able to prepare consolidated financial statement. What are the rules? What are the regulations? What are the guidelines to help us to be able to prepare consolidated financial statement? We all are. We study accounting. Some of us will be accountants in big companies. Almost every big company has got subsidiaries. I've got other companies that they control. So you are expected to prepare consolidated financial statement. So we'll start off by doing an exercise for me to just for you to remind yourself about journal entries and about accounting. Those who have forgotten accounting. And then we'll talk about basic consolidation techniques, and then we'll look at consolidation of a wholly owned subsidiary at the date of acquisition. Then we have exercise and assignment. Good. So some key concepts that we're going to discuss. You will learn today about what is called a net asset value. You also learn about what is called premium. When a company decides to acquire another company, the company can decide to pay a premium. What does that mean? They can decide to pay a discount. In other words, if the company is worth 100 Rand and I decide to pay 150 Rand, how do I account for that? Or if the company is worth 100 Rand and I decide to pay 70 Rand for it, how do you account for that? We will look at intra-group items and common items. Intra-group transaction that takes place between a holding company or a parent and a subsidiary. We'll look at goodwill. What is goodwill? How do we calculate goodwill? How do we account for goodwill? And again, from bargain purchase, and then we will learn what is called the pro forma consolidation entries. Yeah, good. So we're going to be learning about all these things today. Let's move on. So the first exercise that I will give is that I've given 6 accounting transactions, and I want you to prepare the journal entries for me. So the first one is 1 up to 6. So I want you to just spend about 5-10 minutes preparing these journal entries, and then we will talk about them. They are very relevant to what we're going to be discussing today. So I want everyone to participate, and we will do it together. Okay, should we finishing off now?
Yes, we are done.
Okay, good. Cool. So exercise 1, journal entries. Company A purchased a computer for 100,000. What is the journal entry? Who will give that to me?
It's a computer. We debit a computer because it's an asset, and the asset they increase on the debit side.
Good.
Of 100,000.
Yes.
And then we credit the bank with 100,000, bank or creditors, because they didn't specify it was a cash.
Excellent.
Yes.
Excellent. So you debit a computer or an asset, a computer asset for 100,000, and you will credit either bank, that is if you paid for it for cash, or you credit accounts payable for 100,000. Excellent. Excellent. And then the second one, a loan of 75,000 was repaid by company C. What is the journal entry?
It's a loan, 75,000 debit, and then the bank 75,000.
Good. Excellent. Good stuff. Someone else should give me number 3. Interest expense of 40,000 was incurred by company B. What is the journal entry? Interest 40,000 was incurred by company B. What is the journal entry? Anyone?
C and B.
Sorry? If you incur interest, what is the journal entry to record in your books? What do you debit? What do you credit? Interest of 40,000 has been incurred.
Debit the bank, debit the company with the entry of interest expense and credit the bank.
Sorry, come again. I didn't hear you. Debit
interest expense.
Okay.
Can be credit the bank.
The bank. Okay. Yeah. So in this case, the interest has been incurred. It hasn't been paid. So we cannot credit bank yet. So we will debit, we debit interest expense and we credit interest payable. Yeah, interest payable. Yeah. So unless the question specifically says that the interest has been paid, then we know it's going to affect our bank. But if it hasn't been paid, then we can say we credit interest payable. Good. At least the logic is there. You understand it. Good. The next one. Inventory of 75,000 was sold to another company. Inventory of 75,000 was sold to another company. What is the journal entry?
It's going to affect the asset.
Yes, because inventory is an asset. So what do I debit? What do I credit?
Then it's going to be minus inventory, then plus the bank. Because the question, it was not indicated whether it's brought by credit or not, or cash.
Good. So, but you sold inventory, right? You didn't buy inventory. In this case, you actually sold inventory.
Yeah. So
so if I sell inventory, normally what do I debit and what will I credit? General, it doesn't have to be. We're not going to. Yeah.
If you sell inventory, you're receiving cash, so your bank will decrease. So it decreases on the credit side, and then the inventory, you're receiving the cash, yes, and then the inventory is also decreasing. So you're going to credit the 75,000.
The 75,000. Okay, good. So I debit bank because I'm receiving money, right? Because I'm selling something, inventory. And also my asset is gone down. So I need to credit inventory. Good. And that is what I want, the logic. That's what I want. Thank you. Excellent. The next one, number 5. Shares of 70.
Sorry. Just repeat the entry.
Yeah. So you debit your you debit bank. You debit bank because you've sold something, you are expected to receive cash for it, right? Okay. Yeah, so you can debit bank or you can debit accounts receivable in case you have not received the money right now, right? So it's either debit bank or you debit accounts receivable. And of course, the main purpose of this entry was for me to gauge in terms of the logic behind what is going down, what is going up, and so on. In the case of number 4, a lot of things would take place. You first record the sales, and then you also record the cost of sales. But we just want to make it very, very simple, because the purpose is to get the logic behind it, that you know that okay, an asset is going down and an asset is increasing, and so on and so forth. So that is what I'm happy about. But if you really want the correct journal entry, yes, you debit accounts receivable or you debit bank if you have received cash for it. Then you credit sales, right? Because you have sold something. Then you come to the inventory. You debit the cost of sales and you credit inventory. So there are 2 parts to this journal. That is if you want to be 100% correct. You debit bank or debit accounts receivable, credit sales, right? That is the first part. Then you come to the inventory part, where you will debit cost of sales and you credit inventory. Yes. Yeah. Good. Number 5, shares of 70,000 was issued by Company Y. Company Y has issued shares. What is the journal entry?
Our bank be debited by 70,000, and our shares capital account would be credited.
Powerful. Very, very nice. That is it. So I've issued shares. I debit bank because I've received money for the shares, right? Then I need to credit what? Share capital or my share account. Yeah. Yeah, excellent. So debit bank because I've received money. Whenever I issued, I'm a company and I issue shares, I get money. So my asset has increased, so I debit bank. Then the credit side is that I have increased in the number of share capital. So I credit share capital.
Yes.
Good. Excellent, guys. Excellent. Right. The last one, inventory of 200,000 was purchased for cash. Inventory of 200,000 was purchased for cash. What is the journal entry?
Going to be
You debit the inventory
asset
of 200,000 and then you credit bank because your cash is decreasing.
Excellent, guys.
200,000.
Excellent. 100%. So I'm debiting my inventory and asset because an inventory has increased, and I'm crediting bank or cash because the cash has gone down. Good. Guys, you have done so well. It means that you are still on top of your account. That is what I want. Okay. Now we move to exercise 2. I've given you some I think how many? 1, 2, 3. Yeah. We will talk about, I'm just giving you about 5 minutes. We'll talk about this together because this is more related to consolidated financial statements. So I'm just giving you 5 minutes just to think about it and apply your mind. Write something, jot something down. Then we'll do it together as a group. Alrighty, good. Let's continue. So who can give me the answer for the first one? Company B, the subsidiary, issued 10,000 shares for 40,000 Rand to Company A, the parent. Record the journal entries in the books of Company A and Company B. Okay, so let's start. Company A, or whichever one. Let's start with Company B. How would the subsidiary record this issue of shares in their own financial statements? What is the journal entry? Remember, Company B is recording this in their own financial statements. What is the journal entry for Company B, being the subsidiary that issued the shares?
Bank will be debited because there's an increase of 40,000 and the share capital account will be credited for the decrease.
Good, excellent. So in the books of the subsidiary, they have issued shares. So I'm expecting that I'm expecting to see an increase in bank, right? And the corresponding, so debit bank of 40,000, and we credit our share capital, assuming that the share capital is also 40,000. That will also be 40,000. So debit bank of 40,000, credit share capital of 40,000. Good. That the subsidiary has issued shares. Does everyone understand this? Do you know why bank is going to increase by 40,000? Does everyone understand? Okay, good. Do you know why share capital is going to be credited in the books of the subsidiary?
Yes, because it's an equity account.
It's an equity account. Good. So when I issue shares, I get money for it, and then I need to credit my share capital. Good. What about the parent company? What journal entry is it going to process in their books?
Well, bank's going to be credited because it decreases, and their stock investment account will be debited as there is an increase.
Try again.
No. Okay.
Why can't you?
Okay. Let me try.
Yes.
I'm saying the share capital 40,000 is going to be debited, and then the retained income is going to be credited of 40,000.
Why would this transaction affect the retained income? Why would this transaction affect the retained income? What do you think? Will it affect retained income? And if it will, why? The first question is that will it affect retained income? And if yes, why? If no, why? Yes. This is the parent company. So the parent company is buying shares, right? So as the subsidiary is as company B is issuing the shares, the parent company is buying the shares. So what do you think they're gonna do? They are buying shares. So what would they record?
Oh, okay. Let me say the opposite then. Let me say the opposite.
What is the opposite?
Is the retained income is gonna be debited.
And what is
then
going to
the share capital?
Share capital.
Share capital.
Share capital.
I'm confused with this one.
The first lady who spoke, so I didn't get your name. What were your entries again? The one that I said try again.
We said that the bank was credited, or your cash accounts credited.
Yes, that is correct. That is correct. And then what do you debit?
Is debited.
What is debited?
A stock investment account.
Investment account. Yes, that is right. That is right. Sorry, I didn't hear you the first time. I didn't hear you the first time. So yes, so you debit the investment account because what? You bought shares in a company. When I buy shares in a company, it's an investment. So I debit an investment asset or an investment account, and I credit bank, right? Because I bought shares. So as I'm crediting, as my cash is going out, I'm giving it to the subsidiary who recorded as a debit to their cash, and then they will increase their share capital. You see, so from the point of view of the subsidiary, they will debit cash because they have received money from the parent company. And what would they credit? As they issue shares, their share capital has increased, so they will credit share capital. So debit bank and credit share capital for the subsidiary. For the parent, they have acquired an investment. Therefore, they will debit investment and they will credit bank. Because of course they use money to acquire that investment. Does everyone understand this?
Oh, it makes sense now. Yes.
Yes, this is very important. If you understand this, pro forma journal entries become very easy. Very, very easy. This is the crux. One of the crux of consolidations. Good. The next question. Account receivable of 100,000 is certain in the statement of financial position of a company A. What is the corresponding balance in company B if company A and B belong to the same group of companies? So one company has got accounts receivable. What would the other company have? Assuming they had a transaction between the two, A and B. They had a transaction which resulted in 100,000 accounts receivable in company A. What would be the corresponding balance in company B?
$100,000 accounts payable.
100,000 accounts payable, 100%. 100,000 accounts payable. Remember, from the first part of this exercise is that we are actually seeing that when there's a group or companies, a subsidiary and a parent, they are having a transaction. One person will have the opposite side of the transaction. One will have the one leg of the transaction, and the other will have the other leg. Right. So in the same way it happens here. If I have accounts receivable in company A, I'm expecting to see an accounts payable in company B because we had a transaction together. We are a parent and a subsidiary. If we had a transaction between ourselves and the transaction has resulted in accounts receivable in one company, I'm expecting to see an accounts payable in the other company. Because is that not how double entry works? Debit something, credit something. You see, so always there will be an opposite and corresponding entry in one of the entities. If there's a negative there should be a positive there, right? For example, let's give an example just to make it clearer. Let's say I'm company A, which is the parent company. I gave a loan to company B, which is my subsidiary, right? So in the books of company A will say that I'm giving a loan, right? Company A, the parent, will say debit loan assets and credit bank, because I've given a loan to a subsidiary, right? So in the books of A will have what? An asset, a loan receivable. Let's see the entry that B will process. B will say, oh, I've got money. I'm debiting bank. Guess what they will credit? They will credit what? Loan payable or loan from parent company. So when there is a transaction between group companies, there's always one entry is certain in the parent, another entry is certain in the subsidiary. They are opposite entries, but they are the same amount. As one is recording an asset, the other company is recording a liability. You get it? So one company is recording an asset, another company will record a liability. One company will record a liability, the other company will record an asset. Because when there's a transaction, one party will always have an asset. The other party will always have a liability. So whenever I'm dealing with a group and I look at the statement of financial position of one company and I see loan to subsidiary, I'm expecting if I'm an auditor, right, and I'm auditing this company, and you give me the financial statements of A, and I see that, oh, loan to subsidiary. I'm supposed to go to the subsidiary and say, hey, subsidiary, give me your financials. I'm expecting to see what? A liability of that same amount sitting in your book. If it's not happening, then the journal entries were not processed correctly. There's something wrong, and the auditors will pick it up. So it's very important that when you are working in a group, there's always when one company has an asset, the other company will have a liability. Good. The last one, company A and B, same group, sells to each other, and this results in a profit of 25,000. How should this profit be accounted for? Company A and B are in the same group of companies. They sell to each other. You know, a group of company can sell. A parent can sell to a subsidiary, or a subsidiary can sell to a holding company or a parent. This resulted in a profit of 25,000. How should this profit be accounted for? Who can try this? 100,000. I'm joking. How should the profit be accounted for? What do you think? Don't tell me the journal entries. Just tell me in general. What do you think must happen? Yes.
I think the profit should be eliminated because the company can't make a profit, can't sell to the company.
Good, excellent, 100%.
To itself,
this profit should be
sell to itself.
Exactly,
yeah.
You cannot sell to yourself. When you are a subsidiary and a parent, and you form a group of companies together, the transaction will be see you as one economic entity. And since you are one economic entity, you cannot sell to each other and make a profit. That is not allowed according to International Financial Reporting Standard 10. That should be eliminated. So companies cannot sell to each other. You cannot sell to yourself. It's like I'm Gordon and I say, okay, let me sell to myself. Once I form a group of company, we are one group. We are treated as one economic entity, and hence you cannot sell to yourself. Why are you not allowed to sell to yourself? Okay, I've said it. It's one economic entity, but what is the other reason that you cannot sell to yourself? What is the other reason why you can't sell to yourself? Why can't A sell to themselves and make? No, sorry, it's not that you cannot sell. Well, you can sell to yourself, but the profit has to be taken out. Why must the profit be eliminated? What other reason can you give?
Because if you are in one group, you are regarded as you are in one entity. So you can't sell. An entity can't sell to itself.
Yes, that is one reason.
Number one. And then other people. Yeah. And then other people, they can't see that you made a profit because it's inside the group.
Yes. That is true. What you have said 100%. And the main thing is that, can you see that the company, the group of company, they can actually cheat. They can actually sell to themselves and make what is called fictitious profits, right?
Okay.
So if I'm an auditor and I'm auditing this company and I see that these companies are a group of companies and they tell me that they actually made profit of 100 billion by selling to themselves, I should be very skeptical. I'll say, wow, how come? Because companies that are together, that are one group, they can decide to say, hey guys, no, let's collude. Why don't you just assume that we are let's assume we are actually making a proper profit. Then they can end up increasing their profit, and which is not correct. Okay. It's not right.
Yeah.
You know, so when auditors are auditing a group of companies, they are very skeptical to say, listen, there might be fictitious sales here. I must be very careful because companies that are together as group, they can decide to make fictitious sales, things that just to increase or to boost the profit, because they've got the liberty to sell to each other, right? So the tax law, even SARS, looks at them very funny and say, hey, you know what? If you're a group of companies and you make sales to each other, I'm not accepting it, because you can forge it, because you are together, you are one group. You can decide to that, let's increase our profit by selling it. So if I'm selling an item that is normally I sell it to outside for 100,000, I can decide to sell to my subsidiary for 200,000 just to increase my profit, which is not right. And then people would think of when you are a listed entity in the JSE, they think, this company is doing so well. Meanwhile, it's not. They are cheating. You see? Good. So whenever there are two companies and they are together and they are one, they form a group of company and they make profit, that profit has to be eliminated for the reasons I've explained. They have to be taken out. Good. Excellent. Now, how do we account for groups? How do we account for consolidation? Okay, thank you. Thank you for thanking me. Accounting for groups. How do we account for groups? It's very easy. You bring the financial statement of the parent entity. You bring the financial statement of the other entity. You join them together on a line-by-line basis. So basically, you add the income of company A to the income of company B. You add the accounts receivable of company A to the accounts receivable of company B. You add the inventory of company A to the inventory of company B. You add, so everything that is on the financial statement, be it income, expenses, liabilities, assets, whatever, you add them together on a line-by-line basis, right? Then you make certain adjustments. Then after you made the adjustment, you have what is called a consolidated financial statement. A consolidated financial statement. So it's very simple. You put A limited financial statements plus B's limited financial statements. You make then after joining them together, you make adjustments. Then after you have made the adjustment, they become group consolidated financial statements. So what are some of the adjustments? The adjustment is what we have just spoken about. eliminating the profit that has happened between the companies, eliminating the balances that whenever there's a transaction between the two, one company will have an asset, the other company will have a liability. That balance, those balances, a debit and a credit, one leg is sitting in A company, the other leg is sitting in B company. That thing they have to be eliminated. They have to be cancelled as well. So you eliminate profit, you eliminate balances, and you also eliminate the initial transaction that took place initially when the holding or the parent company acquired the subsidiary. So those are the adjustments that you make. So consolidation is very easy. You bring, I'll recap. You bring the financial statement of A Limited, you add it to the financial statement of B. You make adjustments. What are those adjustments? You eliminate intercompany balances, the accounts receivable or the debit, the loan and the asset that is sitting in both sides of the entity. You eliminate them. You eliminate the unearned profits, those profits, and you also eliminate the initial entry that happened. I'll explain to you as we go along. The initial entry that happened when we initially bought the company, and you've got consolidated financial statements. That is it. Any questions so far?
No.
Good. So we can continue. All right. So this is what I've just said. 3 steps in consolidation process. The first step is that you combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of the subsidiaries. That's step number 1. You add them on a line-by-line basis. 2, you offset, you eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of the equity of each subsidiary. I'll explain to you. Then thirdly, you eliminate in full the intra-group assets and liabilities. So what we spoke about, the loan on one side and then the asset on that side, or the accounts receivable on one side and account payable on one side, they have to be eliminated. Then you also eliminate the intra-group equity, intra-group income, intra-group expenses, right? Good, expenses. And then, so let's look at expenses, for example. When we are a group of companies, one company will record expense payable. The other company will record expense receivable. Or one company will record interest income. The other party will record interest expense. Right? And so on and so forth. Good. So these are the 3 main process of consolidating. Step 1, combine the assets and liabilities and income and expenses on a line by line. Add them together. This plus this plus is so easy. Step 2, eliminate the transactions that have happened between the two. Record them at acquisition transaction. Then number 3, any intra-group transactions, any transaction that has happened between the subsidiaries or between the subsidiary and the holding company, they have to be eliminated. Good. So before we do exercise, I want to explain something to you. So the first question that we did, we said that when an entity, when a holding company buys or invests in a subsidiary, in the group of the holding company or the parent, they will say debit investment, let's say 10,000, credits, what, bank, because I bought an investment, 10,000. This is in the books of the holding company. Now the subsidiary will say, okay, I've got money because they bought an investment for me. So now I'm debiting bank and I'm crediting share capital. Right. So that debit investment and credit share, the investment of 10,000 rand and the credit share capital of 10,000 rand, they have to be taken out because it is a transaction between the two. The holding company has recorded debit investment of 10,000. The subsidiary has recorded credit share capital of 10,000. That those two journal entry, they have to cancel out, they have to be eliminated. And how do we eliminate it? By putting a journal entry in the opposite direction. Right. So we would now credit investment of 10,000 and debit share capital of 10,000. When I do that, I've eliminated that transaction. I've passed a transaction which is directly opposite to what is in our books. And by so doing what, I've canceled the transaction. Does this make sense?
Yes.
It makes sense? Is everyone clear on this?
Can you please explain again?
Yes, I'll repeat it. Good. So when a parent company acquired a subsidiary, the parent company passed a journal entry in their own individual books to say, okay, I'm a holding company. I've bought an investment in a subsidiary, so I'm debiting investment asset of, let's say, 10,000, and I am crediting bank because I bought it for cash of 10,000. So in the books of the holding company, in the individual books of the holding company, they have passed a journal entry to say debit investment 10,000, credit bank 10,000, which is correct, right? Because they actually bought an investment in a subsidiary. Now in the books of the subsidiary, right, they will also have to record this transaction, right? The transaction that took place. So they will say debit bank, because the holding company has given me money by investing in me. They gave me money to acquire my shares. So debit bank 10,000 and credit share capital.
Share capital.
Yeah, of 10,000. By the subsidiary issuing shares to the parent company, they need to increase their share capital by crediting share capital. So they debited bank 10,000 and they credited share capital of 10,000. So you see, in the holding company has recorded a transaction in their books, debit investment, credit bank. The subsidiary, on the other hand, has also passed a journal entry in their books, debit bank, credit share capital. This is a transaction between the two group of, they are the same group. We have to eliminate it because according to International Financial Reporting Standards, that transaction is a transaction between two entities in the same group. We don't want it. Cancel it.
Okay.
And how do we cancel it? By putting a journal entry in the opposite direction. So we will credit investment.
Okay.
And we will debit share capital.
Share capital. Yes.
Yeah. So we credited the investment because the holding company has put debit in their book, so we are crediting that. Then the subsidiary has put credit of share capital, we are debiting it. So by changing debit to credit or credit to debit, we are canceling the transaction.
Eliminating it. Thank you.
Yeah, we are eliminating it. Do you understand?
All right. Yes.
Does that make sense? Gabriela, do you understand?
Yes, thanks.
Taboko, do you understand? Oh, wait, do you understand?
Yes, I understand.
Good. Levitt, you also understand? Good. Cool. Nkosi in the way?
Yes.
You are sharp.
Yes.
There was a hand, Mr. from
no, I think you were just doing me sharp. or was there a hand?
I think he now it's not up anymore. Mr. Mbingwenya, your hand was up.
Mbingwenya asked me. What is it? Ask me the question.
No, it was a mistake. I wanted to react.
Oh, okay. Oh, you wanted to react. Okay. Okay. Good. Thank you. All right. Cool. So does that make sense? So, guys, this is it. This is it. We can even close the lecture and go home. We are done. This is the crux of consolidation. If you understand this, there's no consolidation that you will not be able to get 100%. This is it. And you need to understand why. Why am I doing this? Why am I passing this into? Why? Always the why. Why am I doing this? That is more important. Once you understand the reason behind it, you will never forget it. You never forget. Okay, good. Let's continue. So we'll look at questions now. We'll look at questions. And I chose questions from your study guide so that when you are revising, and also this is the level at which your assignment is pitched at. So when you revise them, at least you've seen it for about a second or third time, which will be easier for you to actually to go through. And I think they are very good questions. They are very, very good, very good questions. So let's tackle question number 1 together. Let me give you 2 minutes just to read it for yourself and try to make sense of it. Make sense of it. 2 minutes.
Okay.
Okay, 1 more minute.
Okay.
Good. Let's tackle this question.
Yes.
So, yes. So when it comes to accounting, whether it's management accounting or financial accounting, the most important thing is not just to know how it is done, but to understand the principles. And once you understand the principle, you will see how accounting becomes very, very easy because you understand it. It becomes very easy. So we'll learn the principle, and that's why I want you to ask me questions. Why are we doing it this way? Why? It is the why that is going to be able to make it easier for you, so that you don't cram things and say, oh, this is how it is done, but at least you understand. Good. The following example illustrates the elimination of the investment in the parents' books at the date of acquisition. 1. Statement of financial position as at 28 February 2005. So the company, they have given us the statement of financial position as at 28 of February 20.5 for A Limited and B Limited. A Limited, I think, is the parent company, and B Limited is the subsidiary. So they've given them to us to say that the investment in B Limited, right? So in the books of A Limited, they have investment in B of 10,000. That entry that they passed when they initially bought B Limited to say debit investment and credit bank, that is what they are recording here. To say investment in B Limited, 10,000. Then they have cash and cash equivalent. In the parent A Limited, they have 10,000. B Limited, they have 10,000. So they've given you only like an extract of their balance sheet. They haven't given you all the balance sheets. They've just given you all the statement of financial position. They haven't given you all the statement of financial position. They've just given you just 2 items just to illustrate the consolidation principle. To say in the books of A Limited and B Limited, they've got investment. A Limited has got investment in B of 10,000, and then cash and cash equivalent of 10,000. Now let's look at the equity and liabilities. Share capital in A is 20,000. The share capital in B is 10,000. I'll pause here. Ask me a question. What don't you understand? This is the state, yes.
Okay.
So that
The
entry
question needs a statement of financial position, which means we are going to say asset. Under the asset, we have current asset. We are going to add cash and cash equivalent together to give us 20,000.
Yes.
Therefore, we move to equity and liabilities. Under equity and liabilities, we took the 20,000 of share capital of the parent company. Then it's going to balance asset and liability. It's going to be 20,000, both of them. Therefore, we will find out how many percent the parent has invested in the subsidiaries.
Good. Good. You are there. You are there. 99%. You are there. Thank you for that. So we read through the question, right? The question says that draft the consolidated statement of financial position for the A Limited Group at 28 February 20 S5. Assume that A Limited acquired its interest on that date. So on that date, the 28th of February 20 S5, that is when what the parent company acquired the interest in B Limited. And B Limited was also incorporated on that day. This sentence is very, very important. It's telling me that when B was incorporated, when B started operation, that was when A acquired it. So B was not in existence before A acquired it. So as when they started operating, when B opened its doors to business, immediately A came and acquired it. That means all the assets and all the expenses and all the liabilities and whatever, A is entitled to share in them. But don't worry, we won't get we will not get complicated. We will just so all that this financial position is telling us is that in the books of A Limited, which is the holding company, they've got investment in B Limited of 10,000. Then they've got a cash of 10,000 in A, and then B has also got a cash of 10,000. If you look at the equity and liabilities, we got A has got, or the holding company has got share capital of 20,000. Then B has got 10,000. So what does that mean? It means that this is the 10,000 that B recorded when it said debit bank credit share capital. So this 10,000 must be the 10,000 that B issued to A, isn't it? This 10,000 share capital is the share capital that B Limited gave to A when A acquired it. Does that make sense? Must I repeat? Investment in B Limited at fair value, investment in B Limited, 10,000. So in the books of A Limited, they've got an investment in 10,000. This was the same investment that we just learned, that in the books of A Limited or the parent company, they process a journal entry to say debit investment, asset, and credit bank. That investment asset is the 10,000 that is here. Investment in B Limited at fair value, 10,000. When we come to the equity side, that is the journal entry that B put through when they initially issued the shares to A to say debit bank and credit what? Share capital. So it is because of the shares that B issued to A. That is why B has got a share capital of 10,000. Does this make sense? I know I'm going slowly because this is very important. This is it. This is all what consolidation is all about. Does everyone understand this? Taboko, do you understand?
Yes.
Okay. Babawa, do you understand? Ingwenya, does it make sense?
Yes.
It does. Good. Good. Okay. So you know where the investment of 10,000 is coming from, and you also know where the cash and cash equivalent. You know where the investment in B Limited of 10,000 is coming from, and you also know where the share capital of 10,000 is coming from. Right. A had its own share capital of 20,000. We don't worry about that. A is a parent company. It was in existence long before it acquired B Limited. It has its own cash and bank. It had its own share capital. But when it acquired B, it put a journal entry in their book to say debit investment, which we are now seeing of 10,000, right? And B, on the other hand, made a journal entry to say credit share capital, debit bank. That share capital of 10,000 is what we are seeing here under share capital, ordinary shares of 10,000. Good. Now, they say that prepare the financial statements. Prepare the consolidated statement of financial position for A Limited Group at 28 February 20.5. What is the method for consolidation? What is the first method we do? What is the first step for consolidation?
We eliminate.
No. What is the first step?
To find the percentage.
What is the first step?
To combine.
We combine.
Combine.
We combine.
Yes.
Don't forget, the first step in consolidation is that we combine. We combine the assets. We combine the liabilities. We combine equity of the total. We just add them together. That's the first step.
Okay.
Then after we have done the first step, then second step is that what we make adjustment. Then once the adjustment has been made, then we can get our group consolidated financial statement. Don't forget these three steps. The first is to combine. The second is to eliminate. And the third, then you have your group and consolidated financial statement. Don't forget that. The first is to combine. The second is to eliminate. And the third is then you have your annual financial statements. Good. So let's apply it here. So we have been asked to prepare the consolidated financial statement. I know the process in my head, because the thing is that when it comes to exams, we give marks for the process. So if this one, the fact that I've combined the two, the fact that I've combined A Limited and B Limited, already I'm 50%, I've got a pass mark. I'm passing already. Yeah, you understand? The fact that I've combined the two, it gives me a mark. Every line item you combine is a mark. It's a tick. It's a tick. So if you miss the step and you start eliminating when you have not combined the two, you are missing all those marks. Good. So we can see that the cash and cash equivalent. What would be, so when we prepare the consolidated financial statement, what would be the cash and cash equivalent? What would be the cash and cash equivalent of the combined of the consolidated financial statement? What would be the amount?
20,000.
20,000. How did you get 20,000?
Because we combined the A and the B.
Good.
Cash and cash equivalent.
Excellent. So all you have to do is as easy as grade 1 or grade 2. Take 10,000, take 10,000 from A, combine it with the 10,000 of B, and you've got a 20,000 for cash and cash equivalent. Then you combine investment in B, 10,000 to that of B, what? 0 here. So what do you have? Investment in B, 10,000 only. Remember, the first step is that you combine them before you eliminate, right? We have not eliminated yet. We are just doing the combination. So we combine everything. We also come here and combine share capital. We combine 20,000 with 10,000. We get 30,000. So in the group, in our consolidated financial statement, the first step is that we have investment in B of 10,000, cash and cash equivalent of 20,000, and share capital of 30,000. That is the combination, first step. Then the second step, we know that there are certain things that have to be eliminated. What are the things that need to be eliminated? The investment in B Limited has to be eliminated. Yes. So then we add what? A negative 10,000. So if I add 10,000 and negative 10,000, it gives me what? 0.
0.
Then I also know that this share capital, the 10,000 of B share capital here, needs to be eliminated. Why? Because the journal entry to eliminate it should be credit investment of 10,000 and debit share capital of 10,000. Good. So if I've got share capital of 30,000 and I debit of 10,000, I'm left with what? 20,000. If I have 10,000 of investment in B Limited and I credit it, I've got 10, I've got 0. So you see how easy consolidation is. Add them, eliminate. Add together, eliminate. Good. So this is the journal entry. So this is the working, the pro forma journal entry. Debit share capital, 10,000, which was the share capital that the holding, the subsidiary, the subsidiary said credit share capital, but because we are eliminating, we are debiting it. The parent, A Limited, said debit investment, but because we are eliminating, we are crediting it.
Crediting it.
Yeah, so we are passing an opposite entry to cancel it out, to eliminate it. Let's look at our consolidated financial statement. We have cash and cash equivalent of 20,000. That is it. And then we have share capital of 20,000.
20,000.
You see, because we added the 10,000 plus 10,000 cash equivalent, we got 20,000. But for the share capital, it was 10 plus 20, and then we took out the 10, leaving 20,000. Same we did for the investment. It was 10. It was 0 plus 10,000. Then we credited the investment by 10,000. We got 0. So investment does not feature here in our consolidated financial statements. We have eliminated it. Does this make sense?
Yes.
Any question? Because this is it. This is it. It can never be more complicated than this. As we go along, we look at other subsidy, like associate and whatever, but the principle is the same. The principle is the same. Can we continue? So the rest is going to go very, very fast because now we understand. The rest is going to go very fast. Probably 10 minutes and we are done. Do you understand? Good. Any questions before I move on? You understand why we only have cash and cash equivalent of 20,000 and share capital of 20,000. The others have been eliminated. The process was that we combined them on a line-by-line basis and we made a journal entry to take them out. We credited investment of 10,000 and we debited share capital of 10,000. We eliminated it. Good. Now it's getting, now they are bringing more stuff, but it's still easy. It's easy as ABC because we understand the principles. So it is easy for us. Let's look at this question. I'm giving you 2 minutes. Just read it and just assimilate it. Just think about it. 2 minutes. Good. Let us continue. So the following example illustrates the elimination of investment in the parent record a few years after acquisition. So the difference between the FAC exercise we did and this one is that the first one, we acquired it as soon as the business of B started. But this one, B was actually in operation, then later on, A came to acquire it. You see the difference? The first one we did, immediately B started operation, A came to acquire, A came to take control, or A came to acquire it. Now, in example 2, B was actually in operation for some time before A came to acquire it. How do I know that? Because I can see that in the statement of financial position, there is retained earnings. The fact that there's retained earnings tells me that the business has already been in operation. The first exercise we did, there was no retained earnings. There was nothing. That means the business had just A Limited didn't even give it enough time for the business to build any income or retained earnings before they came to acquire. So in the statement of financial position, there was no retained earnings. But in this case, there is retained earnings. So that means the business has been in operation for some time before A came to acquire B. Good. So we have assets, investments, the same investment in B Limited of 10,000. What does that mean? It means that when A came to acquire B, A passed a journal entry in the account, in their financial statement to say, debit investment asset of 10,000 and credit bank. Then B also made an entry in their financial statement to say, debit bank of 10,000 and credit share capital. So that share capital of 10,000 here under B, you know that it has to be eliminated. And this investment under the asset, the investment in B Limited of 10,000 has to be eliminated because they are common transactions which needs to be eliminated. So once again, what is the let me see, what's the required? Oh, required. Draft the consolidated financial statement of A Limited Group at 28 February 2009 in a compliance with the requirements of International Financial Reporting Standards. Assume that A Limited acquired its interest on 28th of February 20X5 when B Limited was incorporated. This one, it's a mistake. It wasn't when it was incorporated. It was after some time that's when it acquired it. Good. So we've been asked once again to prepare the consolidated statement of financial position. What is the first step? What is step number 1?
Combine.
Combine. Combine. So I know that my end result, the consolidated financial statement, is going to be trade receivables and other receivables, 12,000 plus 8,000. I'm going to get 20,000. Cash and cash equivalent, 14,000 plus 10,000. I'm going to get 24,000.
24,000.
Good. Then share capital. Initially, when I combine share capital, I'm going to get 30,000, but I know that I'm going to have to eliminate the 10,000.
Yes.
Then investment in B Limited, 10,000 plus 0, giving me 10,000, but I know I have to eliminate it. Good. Then you also combine retained earnings, 16,000 and 8,000. You also combine them. Yes, you also combine them to 24,000. Good. So we've done the first step. We combine them on a line by line, add them together. So we prepare our pro forma journal entry. Debit share capital 10,000, credit investment 10,000. Good. Because I'm credited in investment and share capital, I've eliminated that 10,000. So in my consolidated statement of financial position, I only have trade and other receivables 20,000, cash and cash equivalent 24,000, share capital 20,000. Why 20,000? It was 30,000, but I've taken out 10,000 by the elimination, leaving share capital of only that of the parent, of the parent. Good. Of the parent, leaving that of the parent 20,000. Then retain earnings 24,000. You are done. 100%. You are done. You just follow the process. I combine, I eliminate. I combine, I eliminate. I'm combining and then I eliminate the ones I need to eliminate. Does that make sense?
Yeah.
Any questions? The rest, I think, is the same. Example 3. I'm giving you 2 minutes. Read through this question and let's tackle it. Very easy. Same principle. Same principle. But we will just add something small just to make your life easier. Just read it. Okay. Acquisition of at net asset value. Acquisition of a subsidiary at net asset value. This is an interesting question. So the following represent the average statement of financial position of A Limited and its wholly owned subsidiary. What does wholly owned mean? When we say wholly owned, what does that mean?
100% owned.
Good, excellent. 100% ownership. 100% ownership. So you can have 100% ownership. You can have 75% ownership. You can have 80% ownership. You can have, so as long as it's more than 51%, you have control and you can consolidate. So you can have, so the 75, 80, 95, even 99, we call them partially owned. But when you have 100% ownership, then you got wholly owned subsidiary. So this word wholly owned is telling us that A has acquired 100% of the shares of B Limited. 100%. And I think we did this yesterday. Yesterday we went into the whole control and all that. Good. So A Limited.
I didn't get an invitation for yesterday. Sorry.
Oh, is it? Then you have to speak to Abase. Abase, some of the students didn't get invitation.
Are we getting the recording?
Yes. Yeah, some.
I think he's prepared, willing to deviate from a plan that may have been discussed beforehand. I think he pushes for more wickets when a team is under pressure when they're in the red zone. He keeps them in the red zone. I think he's very, very good tactically. I know that a lot.
Thank you. Good.
Sorry, let me answer on behalf of Abase. I don't know. The link that you used today is the link that was used yesterday. If you can check the link that you connected with it started from today and it's finishing yesterday. And note, I'll write about the recording on the chat. They won't be sent to you, but there will be a way for you to access the recording of yesterday and today.
Okay, thank you.
Thank you.
Good. So A Limited and its wholly owned subsidiary B Limited at 31st of December 20X5, which is the date on which A Limited acquired its interest in B Limited. So whenever you read a question, whether it's in exams or in your assignment, you read it, you underline the important things. And one, you underline who is the parent company, you underline the date of the acquisition. These are very, very, very important. So we'll be giving to statement of financial position A Limited and the wholly owned subsidiary B Limited at 31st of December 20X5, because sometimes the date of the statement of financial position may not be the same date as the date of acquisition. So it's very important for you to note those dates. And as we get into consolidation, you will see the importance of those dates. We're taking it one step at a time. And that's why I like UNISA so much. The way they do the study, they make you understand it, and they go gradually, you know, for you to understand. Okay, so wholly owned subsidiary at 31st December 2025, which is the date on which A Limited acquired its interest in B. Good. So A Limited acquired B on 31st of December 2025. This is the statement of financial position. Investment in B Limited at fair value 90,000. Bank is 30,000. Trade and other receivables is 60 and 35. Sorry, bank was 30 and 55. Investment in B Limited was 90,000. Then share capital, ordinary shares, 100,000 for A Limited, the parent, and 50,000 for B Limited. Retained earnings, 80,000 for A and 40,000 for B. Before we even go forward, what do you see here? What can you see? It's not. What can you see is a bit weird, or what is not ordinary with this question? There is something different about it. Compared to the ones, the two that we have done before.
Total asset and the total equity and liabilities of the subsidiary are equal to the investment, the amount of the investment.
Okay, so that's fine. I think all the other two that we did, they were also the same. The share capital, are you talking about the share capital?
The retain and share capital, the retain and share capital, which means total assets and liabilities of the subsidiaries are equal to the amount of investment.
Yes. Yeah. So the share capital is 50,000. The retained earnings is 40,000, giving us what? 90,000. That's very powerful. You know, I didn't even pay that up. That is powerful. That is good. Yeah. Share capital is 50,000. Retained earnings of 40,000. 90,000 is equal to the cost price of the investment, right? Of 90,000. Good.
Yes.
Yeah. So it means that that is a very important one. So when a company, right, is going to buy another company, how much the company cost will be how the value of that company that I'm buying into will be determined by the value of the share capital. Why? Because if you look at the statement of financial position, what is the accounting equation? Assets minus liabilities equals owner's equity. So if I sell all my assets and I settle all my liabilities, I have what? Owner's equity. So it's telling me that if I want to buy a company, the value of the owner's equity is actually what? How much that company must cost. You get it? Because the accounting equation says that asset minus liability equals owner's equity. If I sell all my assets on my statement of financial position and I settle all my liabilities, whatever is left is what the company is left, is what the company has. Basically, if I subtract my liabilities from my assets, whatever I get is what is the value of the company. So in this question, by A Limited buying the net asset value for 90,000 means that I'm buying it at exactly how much that company is worth. A company is worth by its share capital and the retained earnings, which is their share equity. Share capital and retained earnings gives me the equity. So if the equity is 90,000 and I pay 90,000 for it, then I've bought it for exactly how much the company is worth. That is a very good observation. Thank you so much. That is very powerful. Good, and we are supposed to prepare the consolidated financial statement. So what do we do? What's the first step? As usual. What is the first step? To prepare consolidated. We combine. So bank is going to give me 85,000. Trade and other receivables is going to give me 95,000. Retained earnings is going to give me 120,000. Share capital, I have to eliminate it. Investment in B Limited, I have to eliminate it. Good. So let's see what happened. So there is something we do in consolidation to make our life easier. We do what is called an analysis of equity, and that's how the analysis looks like. So every consolidation question that you get, you do this, what is called an analysis. You have total column, then you have at acquisition, then you have since. Or what you do is that you have total column, then you have subsidiary, then you have the holding company. Something like this, just something to make your life a bit easier. But listen, you don't need, they don't mark the analysis. We don't mark it, but if you get it, if you don't get something right, then we can go to your analysis to check what happened. So it is good to do it, but you don't need to do it. That means if you are really sure and you're good and you can get everything, you don't need, because it doesn't carry marks. But if you get something wrong, then the lecturer can actually go and check your workings in the analysis and say, okay, maybe let me give her or him mark here and there. Good. So share capital was 50,000, retained earnings was 40,000. And I purchased the company for 90,000. That means I purchased it I purchased the asset at the same value as, I purchased the company at the same value as it was worth. What happened if maybe I purchased this company for 100,000? So even though it is worth 90,000, because the share capital is 50, retained earnings is 40,000, even though it is worth 90,000, I paid 100,000. What?
It's goodwill.
It's goodwill.
There's a goodwill involved.
It's goodwill. You guys are smart, eh? You guys are smart. It's goodwill. So goodwill is the amount that is the consideration over and above what the company is actually worth. So whenever you look at the financial position of a company, look at the equity. And so you add equity to us, this company is just 100 million rand. So if I have 100 million, I can actually buy this company. That's what it means. When you have 100 million, you can buy the company. But that is how much the company is worth. And then, so if you pay any amount that you pay over and above that 100 million, is that the difference between the equity and the amount that you paid is goodwill. Is goodwill. What is goodwill? What is goodwill? We always say goodwill. What is goodwill? Who can try? I don't need the textbook definition. Just give me, what do you understand by goodwill? If a company records goodwill of 100,000, what is the company saying? What is that goodwill? I know how you got it, but what is it? To a lay person, what is it?
I can say it's an asset, but you can't show that asset. You can't prove it, but it is there because of because the company has been in existence. So they have a good relationship maybe with their creditors. So if you purchasing that company, you're also purchasing that as well.
Good.
Yeah.
Excellent. So the goodwill is that asset that you cannot really explain. It's like no, that sort of like the brand that you can't really explain, but they are very important. Like I mean, if imagine if someone is going to buy maybe Sundowns, let's use maybe Jomo Cosmos, and someone is going to buy Manchester United. Why would someone pay $1 million for Manchester United and say, okay, for Cosmos, maybe just 100,000? Is the brand name? Is that goodwill? Is that thing that makes, the brand, you know, that thing that makes it worth more? Because I know that once I'm interested. I'm into Manchester United. I mean, it's well known, you know. So that association with that brand even brings you more. It brings you more money. It's an asset, you know. So goodwill is that, and that is why sometimes a company can go overboard to actually to buy a company for more than how much it's worth because of that brand, that thing that makes it what it is. You know, that's what goodwill is. Good.
So
yes, question.
Is there any possibility that it can be bought on loss?
Yes, yes, it can. It can,
Oh.
and we'll look at. I think there's an example in your book as well. They call it you purchase it at a discount. So you purchase the company at a discount. So that is the loss. Yeah.
At a discount.
At a discount. Yeah. That means in this case the company was worth 90. Where am I? The company was worth 90,000 and you bought it for 80,000. You have a loss. You have a loss. And the International Financial Reporting Standards say that when that happens and you have a loss, you must record it in the statement of profit and loss immediately. It's not an asset. It's not a negative asset. You must write it off immediately. Good. That's just by the way. But yes, you can actually have a loss. So the solution, share capital. So the consolidated financial pro forma journal entries is you debit your share capital of 50,000. Remember, you are eliminating it. So whatever was a credit, you are debiting it. So you debit share capital in B Limited of 50,000. Hello guys, can you hear me now? I think my connection was a bit interrupted. Can you hear me?
Yes.
Good.
Yes, sir.
Sure. Okay. All right. Cool. Guys, we are just like 5 minutes away, then we are done. Where am I? Okay, let me make it bigger.
So sorry, sir.
Yes, ask. Are you asking a question?
If the equity and liabilities and asset of the subsidiaries worth the investment, so when we consolidate, there is no need to enter that amount of retaining earnings. There is no need to combine those.
Sorry, come again. You said when we consolidate, there's no need to combine the retained earnings.
The retained earnings. Previously, on the previous example, we have combined the retained earnings for both companies.
Yes.
So here, we didn't combine them. The reason it can be what? It can be the net worth of the investment is equal to the asset and liabilities of the subsidiaries.
Yes. Yes.
Oh, okay.
Okay. Yeah. That is a reason. That is a reason. Yeah.
Okay.
So so in this case, the pro forma journal entries or the consolidated journal entries to eliminate the you remember in the previous example that we did, there was no the parent did not buy into the retained earnings because the parent got or they acquired the subsidiary at the date of incorporation. At that point in time, they hadn't even made any income for some to be in the retained earnings, right? But under normal circumstances, when you go and buy a company, you don't just buy the shares. You actually buy the equity, and equity is made up of shares and retained earnings and non-distributable reserve and all those things that you see on the statement of changes in equity. Those things you buy into them because those are what? That is the equity of the company. And you see that as we progress in consolidation, they will start adding things. You will start seeing the whole picture. So the UNISA will start gradually with share capital. Then they will introduce the retained earnings. But still the principle is the same because it's all what? It's equity. equity, but they will start from share capital, and then they will add things, then you start seeing the bigger picture. So by the time you start doing your assignment, you know it all. You know it all. Yeah. So just follow me letter by letter. You will see that it all makes sense. Yeah. Good. So share capital of 50,000, retain earnings for 40,000. It was 90,000. We bought into it. It was 97. Then we credit investment of 90,000. So by so doing, what have we done? We have eliminated that initial entry that happened when the parent bought into B. Then we have A limited consolidated statement of financial position. We have current asset cash equivalent was 30,000 plus 55,000. We have 85,000. Trade and other receivable 60,000 plus 35,000, 95,000. Then we have equity and liabilities. Equity share capital was 100,000. Retained earnings is 80,000. Why is it only 80,000? Because what? We eliminated the 40,000 belonging to the subsidiary, because it was part of what? The equity. It was part of the equity. So initially we combine. So we combine 80 plus 40 to get 120. Then you minus 40,000 by this journal entry, debit it for 40,000. So the full picture is that 80 plus 40 giving you 180 minus this 40 over here, which is a debit retained earnings of 40. That makes it what? That means you've eliminated. So the 80 plus 40 minus 40 gives 80. They didn't show the plus, but that is it. So the rule is always the same. Combine, eliminate. Combine, eliminate. So you first combine. Then you look at your pro forma journal entry or your consolidated journal entry and look at what you have done. If you have debited it, go and subtract it. If you have credited it, go and add it, and so on and so forth. Then you get the final answer. So in this case, the retained earnings, we added it initially, we combined it. It was 40 plus 80, giving us 120. Then because we have debited it up here, say debit retained earnings, we take it out. So it is 80 plus 40 minus 40, giving us 80,000. Share capital was also the same. It was 100 plus 50, giving us 150. Then we subtracted 50 from it because it was what? Debit share capital of 50,000. So 100 plus 50 minus 50 gave us 100. So the step, the procedure is the same. Combine, then you eliminate. Combine and you eliminate based on the journal entry that you have put through. Does that make sense?
Yeah.
Good. We're almost done at the preview. So this example is the same as what we did the preview, except that instead of us buying the company for 90,000, we actually bought it for 100,000, giving us goodwill. Look at here, equity represented by goodwill of 10,000. So UNISA just wanted us to show us how we got the goodwill. So the asset of the company, or the net asset value of the company, share capital 50,000, retained earnings 40,000, giving us 90. Then we bought it for 100,000, even though the company is worth 90, giving us the goodwill of 10,000. So in our consolidated entry, we will do the same thing. We eliminate, then we recognize goodwill. We eliminate, and then we recognize goodwill. So in goodwill, we are not eliminating goodwill. We are actually bringing goodwill into the company, because when we bought it, we got goodwill. So the same procedure: debit share capital, debit retained earnings. All right, cool. So as you can see, now we have goodwill of 10,000, because instead of the net asset value of 9,000, we actually purchased it for 100,000, giving us a 10,000 rand goodwill. So in our statement of consolidated statement of financial position, we have to recognize that goodwill that we got by buying it at a premium, right? Net asset value was 90,000, but we actually bought, we purchased it for 100,000, giving us that 10,000. Good. Other than that, the same thing. cash 75, trade receivable 95, equity and equity attributable to owners 100,000, share capital 80,000. That's it. Yeah, that's it. These are exercises for your own. It's everything that we have done. Just go through this exercise. It's in your study guide as well, and the solution is there. But it's the same thing. You will never. There's nothing that they do there that you don't know, or that we have not done. Yeah. Just bear in mind that if you happen to have a discount instead of a goodwill, you don't recognize your goodwill. There's nothing like negative goodwill. No. When you have a discount, you will put it into the income statement as a write-off. You never recognize a negative goodwill or a discount. So that's it. Any questions? Any questions, guys? Thank you so much for staying to listen to this interesting thing. It gets more fun. Don't worry. Today it's a lot of theory, but from now on you will do a lot of exercise, and it makes it, and it's more fun. Any questions so far? Thank you, guys. Thank you so much.